Net present value. In finance, the net present value, NPV, or net present worth, NPW, applies to a series of cash flows occurring at different times. The present value of a cash flow depends on the interval of time between now and the cash flow. It also depends on the discount rate. NPV accounts for the time value of money. It provides a method for evaluating and comparing capital projects or financial products with cash flows spread over time, as in loans, investments, payouts from insurance contracts plus many other applications. Time value of money dictates that time affects the value of cash flows. For example, a lender may offer 99 cents for the promise of receiving $1 a month from now, but the promise to receive that same dollar 20 years in the future would be worth much less today to that same person, lender, even if the payback in both cases was equally certain. This decrease in the current value of future cash flows is based on a chosen rate of return, or discount rate. If, for example, there exists a time series of identical cash flows, the cash flow in the present is the most valuable, with each future cash flow becoming less valuable than the previous cash flow. A cash flow today is more valuable than an identical cash flow in the future because a present flow can be invested immediately and begin earning returns, while a future flow cannot. NPV is determined by calculating the costs, negative cash flows, and benefits, positive cash flows, for each period of an investment. After the cash flow for each period is calculated, the present value, PV, of each one is achieved by discounting its future value, see formula, at a periodic rate of return, the rate of return dictated by the market. NPV is the sum of all the discounted future cash flows. Because of its simplicity, NPV is a useful tool to determine whether a project or investment will result in a net profit or a loss. A positive NPV results in profit, while a negative NPV results in a loss. The NPV measures the excess or shortfall of cash flows, in present value terms, above the cost of funds. In a theoretical situation of unlimited capital budgeting, a company should pursue every investment with a positive NPV. However, in practical terms, a company's capital constraints limit investments to projects with the highest NPV whose cost cash flows, or initial cash investment, do not exceed the company's capital. NPV is a central tool in discounted cash flow, DCF, analysis and is a standard method for using the time value of money to appraise long-term projects. It is widely used throughout economics, finance, and accounting. In the case when all future cash flows are positive, or incoming, such as the principal and coupon payment of a bond, the only outflow of cash is the purchase price. The NPV is simply the PV of future cash flows minus the purchase price, which is its own PV. NPV can be described as the difference amount between the sums of discounted cash inflows and cash outflows. It compares the present value of money today to the present value of money in the future, taking inflation and returns into account. The NPV of a sequence of cash flows takes as input the cash flows and a discount rate or discount curve and outputs a present value, which is the current fair price. The converse process in discounted cash flow, DCF, analysis takes a sequence of cash flows and a price as input and as output the discount rate, or internal rate of return, IRR, which would yield the given price as NPV. This rate, called the yield, is widely used in bond trading. Many computer-based spreadsheet programs have built-in formulae for PV and NPV. Formula. Each cash inflow/outflow is discounted back to its present value, PV. Then all are summed. Therefore, NPV is the sum of all terms. Where the result of this formula is multiplied with the annual net cash inflows and reduced by initial cash outlay, the present value. But in cases where the cash flows are not equal in amount, then the previous formula will be used to determine the present value of each cash flow separately. Any cash flow within 12 months will not be discounted for NPV purpose. Nevertheless, the usual initial investments during the first year are zero are summed up a negative cash flow. Given the period cash flow pairs T \displaystyle T RT \displaystyle R sub T, where n \n is the total number of periods, the net present value NPV \math NPV is given by. For constant cash flow R \r, the net present value NPV \math NPV is a finite geometric series and is given by. Inclusion of the R0 \r term is important in the above formulae. A typical capital project involves a large negative R0 \r cash flow, the initial investment, with positive future cash flows, the return on the investment. A key assessment is whether, for a given discount rate, the NPV is positive, profitable, or negative, loss-making. The IRR is the discount rate for which the NPV is exactly zero. The discount rate. The rate used to discount future cash flows to the present value is a key variable of this process. A firm's weighted average cost of capital, after tax, is often used, but many people believe that it is appropriate to use higher discount rates to adjust for risk, opportunity cost, or other factors. A variable discount rate with higher rates applied to cash flows occurring further along the time span might be used to reflect the yield curve premium for long-term debt. Another approach to choosing the discount rate factor is to decide the rate which the capital needed for the project could return if invested in an alternative venture. If, for example, the capital required for project A can earn 5% elsewhere, use this discount rate in the NPV calculation to allow a direct comparison to be made between project A and the alternative. Related to this concept is to use the firm's reinvestment rate. Reinvestment rate can be defined as the rate of return for the firm's investments on average. When analyzing projects in a capital-constrained environment, it may be appropriate to use the reinvestment rate rather than the firm's weighted average cost of capital as the discount factor. It reflects opportunity cost of investment, rather than the possibly lower cost of capital. An NPV calculated using variable discount rates, if they are known for the duration of the investment, may better reflect the situation than one calculated from a constant discount rate for the entire investment duration. Refer to the tutorial article written by Samuel Baker for more detailed relationship between the NPV and the discount rate. For some professional investors, their investment funds are committed to target a specified rate of return. In such cases, that rate of return should be selected as the discount rate for the NPV calculation. In this way, a direct comparison can be made between the profitability of the project and the desired rate of return. To some extent, the selection of the discount rate is dependent on the use to which it will be put. If the intent is simply to determine whether a project will add value to the company, using the firm's weighted average cost of capital may be appropriate. If trying to decide between alternative investments in order to maximize the value of the firm, the corporate reinvestment rate would probably be a better choice. Using variable rates over time, or discounting guaranteed cash flows differently from at-risk cash flows, may be a superior methodology but is seldom used in practice. Using the discount rate to adjust for risk is often difficult to do in practice, especially internationally, and is difficult to do well. An alternative to using discount factor to adjust for risk is to explicitly correct the cash flows for the risk elements using RNPV or a similar method, then discount at the firm's rate. Use in decision making. NPV is an indicator of how much value an investment or project adds to the firm. With a particular project, if RT \r sub t is a positive value, the project is in the status of positive cash inflow in the time of t. If RT \r sub t is a negative value, the project is in the status of discounted cash outflow in the time OT. Appropriately risked projects with a positive NPV could be accepted. This does not necessarily mean that they should be undertaken, since NPV at the cost of capital may not account for opportunity cost, i.e., comparison with other available investments. In financial theory, if there is a choice between two mutually exclusive alternatives, the one yielding the higher NPV should be selected. A positive net present value indicates that the projected earnings generated by a project or investment, in present dollars, exceeds the anticipated costs, also in present dollars. This concept is the basis for the net present value rule, which dictates that the only investments that should be made are those with positive NPVs. An investment with a positive NPV is profitable, but one with a negative NPV will not necessarily result in a net loss. It is just that the internal rate of return of the project falls below the required rate of return. An alternative way of looking at net present value is that at the given rate of cost of capital, whether the project can meet the cost of capital. For example, if the NPV is minus $2.5 million, i.e. negative NPV, for a given project, it may mean that at the given weighted average cost of capital, WACC, the project fails to meet the expectations of the suppliers of capital for the project. On the other hand, the NPV of $2.5 million would add $2.5 million to the wealth of the suppliers of funds over and above their expected returns. Interpretation as integral transform. The time-discrete formula of the net present value can also be written in a continuous variation, where net present value can be regarded as Laplace respectively z transformed cash flow with the integral operator including the complex number s which resembles to the interest rate I from the real number space, or more precisely s equals ln 1 plus psi dot. From this follow simplifications known from cybernetics, control theory and system dynamics. Imaginary parts of the complex number S describe the oscillating behavior, compare with the Pork cycle, cobweb theorem, and phase shift between commodity price and supply offer, whereas real parts are responsible for representing the effect of compound interest, compare with damping. Example. A corporation must decide whether to introduce a new product line. The company will have immediate costs of $100,000 at t equals 0. Recall, a cost is a negative for outgoing cash flow, thus this cash flow is represented as minus $100,000. The company assumes the product will provide equal benefits of $10,000 for each of 12 years beginning at t equals 1. For simplicity, assume the company will have no outgoing cash flows after the initial $100,000 cost. This also makes the simplifying assumption that the net cash received or paid is lumped into a single transaction occurring on the last day of each year. At the end of the 12 years the product no longer provides any cash flow and is discontinued without any additional costs. Assume that the effective annual discount rate is 10%. The present value at t equals 0, can be calculated for each year. The total present value of the incoming cash flows is $68,136.91. The total present value of the outgoing cash flows is simply the $100,000 at time t equals 0. Thus, in this example, observe that as t increases the present value of each cash flow at t decreases. For example, the final incoming cash flow has a future value of $10,000 at t equals 12 but has a present value, at t equals 0, of $3,186.31. The opposite of discounting is compounding. Taking the example in reverse, it is the equivalent of investing $3,186.31 at t equals 0, the present value, at an interest rate of 10% compounded for 12 years, which results in a cash flow of $10,000 at t equals 12, the future value. The importance of NPV becomes clear in this instance. Although the incoming cash flows, 10,000 times 12 equals 120,000, appear to exceed the outgoing cash flow, 100,000, the future cash flows are not adjusted using the discount rate. Thus, the project appears misleadingly profitable. When the cash flows are discounted, however, it indicates the project would result in a net loss of $31,863.09. Thus, the NPV calculation indicates that this project should be disregarded because investing in this project is the equivalent of a loss of $31,863.09 at t equals 0. The concept of time value of money indicates that cash flows in different periods of time cannot be accurately compared unless they have been adjusted to reflect their value at the same period of time, in this instance, t equals 0. It is the present value of each future cash flow that must be determined in order to provide any meaningful comparison between cash flows at different periods of time. There are a few inherent assumptions in this type of analysis. More realistic problems would also need to consider other factors, generally including smaller time buckets, the calculation of taxes, including the cash flow timing, inflation, currency exchange fluctuations, hedged or unhedged commodity costs, risks of technical obsolescence, potential future competitive factors, uneven or unpredictable cash flows, and a more realistic salvage value assumption, as well as many others. A more simple example of the net present value of incoming cash flow over a set period of time would be winning a Powerball lottery of $500 million. If one does not select the cash option, they will be paid $25 million per year for 20 years, a total of $500 million. However, if one does select the cash option, they will receive a one-time lump sum payment of approximately $285 million, the NPV of $500 million paid over time. See other factors above that could affect the payment amount. Both scenarios are before taxes. Common pitfalls. History. Net present value as a valuation methodology dates at least to the 19th century. Karl Marx refers to NPV as fictitious capital, and the calculation as capitalizing, writing. In mainstream neoclassical economics, NPV was formalized and popularized by Irving Fisher, in his 1907 The Rate of Interest, and became included in textbooks from the 1950s onwards, starting in finance texts. Alternative capital budgeting methods.